Hello everyone and welcome to the channel. Well, there's no missing it these days. Warnings of the coming recession and the stock market crashing every day for the past year is all over the news and your YouTube feeds. But I have some good news for you. You don't have to lose money in markets like this. It's true, you can make money in red stock markets. So in this video, I'm going to show you exactly step by step what inverse ETFs you can buy with a click of a button that actually make money as the stock market is crashing. And so one way to make money in a market like this, when everything else is crashing, when everyone else is losing money on stocks as they fall, is to go short or to buy an inverse ETF. And what going short means is that you're betting that stocks will fall in price. Normally this would mean that you have to borrow shares of a stock inside of your stock brokerage, but I'm going to show you actually an easy way to go short on the stock market, going short an entire index without taking risky loans or going out on margin. And you can do this just by buying something called a short ETF and buy and sell it, trade it like a normal stock. These inverse ETFs are almost the same as normal ETFs. The only difference is that these are short rather than long, meaning that when the index they track loses money or goes down in price, a short ETF goes up in price, meaning red days are green and green days are red. Now, why would you buy a short ETF? The main reason a lot of investors do this is because unlike when you borrow a stock to go short, with an inverse ETF, it's impossible for you to personally get margin called just by holding these ETF shares normally, and you don't have a risk of losing an infinite amount of money. The worst that can happen to an inverse ETF is that the price of the ETF per share can go to zero, whereas if you're shorting a normal stock, you could potentially lose an infinite amount of money. This is because if a stock is worth $100 and it goes to zero, well then you've only lost $100. But if you go short a stock betting that will go down and the stock prices increases to $1,000, you just lost $900. That's the difference between $1,000 and $100, meaning you lost more money than you went short and invested in the first place. And as you can guess, on the stock market, stocks can only fall to zero, but in theory, they can expand or blow up to infinity and go up in price. That's why many investors prefer short ETFs, so that way they still don't have that chance of losing an infinite amount of money. The first inverse ETF you should know about is SH. The ProShares Short S&P 500 is probably the most popular inverse ETF, and the reason a lot of investors buy this inverse ETF is that it gives you a negative 1x daily return of the S&P 500 index. So for example, if the S&P 500 index were to drop by $1, this ETF would actually go up in price by $1. Because this ETF pretty much bets against the S&P 500, which is an index of the largest 500 companies on the stock market by market capitalization. In layman's terms, the S&P 500 is just the top 500 all-stars biggest US companies. So meaning that if you buy SH, you're betting that big companies like Apple, Microsoft, Amazon, Alphabet, and Tesla, and Johnson & Johnson, all the big companies on the S&P 500, are going to go down in price. SH has an expense ratio of 0.89%, meaning that for every $1,000 you invest in this inverse ETF, you would have to pay about $8.80 in fees. So for comparison, a normal ETF like SPY, which tracks the S&P 500 normally and is not inverse, that expense ratio is actually just 0.09%. So you can tell that the management fees in inverse ETFs are more expensive. Now these fees are automatically deducted and are reflected in the share price of the ETF, meaning that you won't actually see the money you're losing in fees go out of your account, but it's important that I make you aware of this, just so that you know what's going on in the background. So given that the market has been falling and crashing pretty hard recently, you're probably smart enough to guess that SH has been doing well, but the question is, how well has it been doing? As of this video's release in June, the S&P 500 is down 19.9%, while SH is up this year 21.2%. So for an easy comparison, if you had two stock trading accounts, each with $10,000, and one of your stock trading accounts you invested all into the S&P 500 ETF SPY, because you wanted to invest long-term in the S&P 500, as of this video's release, you would have just $7,715 left of your original $10,000 investment, even if you reinvested all of your dividends. Now, if you bought SH with your other trading account because you wanted to go short on the S&P 500, thinking that those 500 companies would go down in price, your $10,000 investment would be worth $12,570, gaining you $2,570. This is just a snapshot of this moment in time as I'm recording this video, so do your own research, and these percentages could easily change as we are in a crazy market right now and a lot of things could happen. Now, in my opinion, SH isn't a bad inverse ETF, but it's not necessarily the best inverse ETF either. The S&P 500, the index you're betting against with SH, has the strongest and biggest companies in the US stock market, and as a result, they tend to fall slower than other smaller companies and are more likely to get bailouts and stimulus from the government when times are bad, compared to smaller stocks. Also, when liquidity dries up and banks don't have a lot of money to loan out, which is what some people are saying is happening right now in the stock market, the biggest companies are generally the last companies to lose their line of credit from lenders and banks. I've learned that you shouldn't be surprised when the biggest and toughest boxers on the stock market can take more hits compared to other stocks, and when those big stocks are knocked down, they tend to get up faster than the other stocks. It just makes sense that the biggest companies can take more abuse than smaller companies. The next inverse ETF that a lot of investors have been using is SQQ and PSQ. SQQ is the Ultra Pro Short QQQ, which is an inverse leverage ETF that tracks the NASDAQ 100 index. And the NASDAQ 100 is the largest companies, both domestic and international, listed on the NASDAQ stock market, prioritized by market capitalization, so from biggest to smallest, and it excludes financial institutions, so that means it excludes banks and insurance companies. This means that investors in SQQ are preparing for the greater non-financial stock market to struggle. And since the NASDAQ 100 tends to be heavily weighted towards technology, telecommunications, and healthcare and biotech, the SQQ and PSQ tend to perform well when these sectors perform poorly. So the expense ratio in SQQQ is 0.95%, meaning that if you were to invest $1,000 in this inverse ETF, you'd be paying $9.50 in fees. And from the start of this year, if you had invested $10,000 in SQQQ, that investment would be worth now $22,286. In that case, it would be more than doubling your money with a 123% gain since the beginning of 2022. The reason I'm mentioning this inverse ETF is because it's really popular online right now with investors, particularly on Wall Street Bets. I can see that they're talking about it a lot. But what makes this inverse ETF, SQQQ, different from the last inverse ETF I mentioned is that it's a 3 times inverse ETF. What that means is that this ETF uses leverage and borrowed money to increase your gains and losses by 3 times. So it's borrowing 3 times the amount that it's betting on. Meaning that if the NASDAQ 100 were to fall $1, you would make $3 with this inverse ETF. But on the flip side, if the NASDAQ were to go down $1, you'd be losing $3 instead of the normal $1 that would be lost. If this amount of leverage and risk is too much, but you still want to short the NASDAQ 100 and all of its tech-focused stocks, there is a nearly identical ETF called PSQ. And you can see that $10,000 invested in this inverse ETF from the start of the year would be worth $13,769 for a 38% gain. PSQ is different because it's only a 1 times inverse ETF rather than 3 times. My opinion on this one is that SQQQ is a gambler stock, and while it's true that tech stocks have been hit the hardest during this most recent market pullback compared to some of the more mature companies on the S&P 500, the QQQ index has fallen more than the S&P 500, but it's also true that the tech stocks of the NASDAQ 100 were growing and increasing their revenues pretty steadily before the market pullback, and it's possible that these tech stocks are growth stocks and they could recover more quickly compared to other stocks. I don't think anybody is in doubt that tech is a great sector, and it's likely the future of the economy, so while it's true that going short on an inverse ETF like PSQ or SQQ so far has made investors more money than other inverse ETFs, such as people inversing the S&P 500 with SH, caution is definitely warranted in my opinion. You are betting against some of the biggest winners on the stock market on the QQQ index. The next inverse ETF is RWM, which is the ProShares Short Russell 2000. RWM provides a 1-day bet against the Russell 2000's index of 2,000 US small cap firms. And just like all the ETFs before, this one is one of those ETFs that bets every day that the Russell 2000 stocks will go down in price. And so if these stocks go down $1, you make $1 minus the expense ratio. And if those stocks go up $1, you lose $1. And if you look at the top holdings for the normal Russell 2000 index, you'll see stocks like Chesapeake Energy, Range Resources, BJ's Wholesale Club, and Macy's. And as Zoomers would say, these stocks on this index are pretty mid. The expense ratio in RWM is 0.95%, which is about the same before with SQQQ. It's on the higher side, but most inverse ETFs, as I mentioned, tend to be more expensive than normal ETFs. So $10,000 invested at the beginning of this year in RWM would be worth now $12,984, where if you were still going long and just buy and hold the normal Russell 2000 with an investment of $10,000, that investment would only be worth $7,374. For full disclosure, I do currently have a position in RWM, and the reason I chose this particular one is because I learned that during economic times, smaller firms and smaller stocks tend to get hit the hardest and are overlooked when bailouts and help does come from government spending and consumer spending rebounds. So for comparison, shorting the S&P 500 with SH has had a 25.7% gain since the beginning of this year, and RWM during that same time period returned 29.84%, and PSQ, on the other hand, shorting the QQQ index, has returned 37.69%. So you can see that out of these 3 inverse ETFs, RWM is about in the middle of the pack. I like RWM more because to date it has returned more than the inverse S&P 500 bets with SH, but at the same time I feel that it's less risky to bet against the QQQ with PSQ. And you can see that it's at the middle of the pack. It's not as risky necessarily as PSQ in my opinion, but it returns more than betting against the S&P 500 with SH. Now, of course, it's impossible to deny though that this most recent market cycle, up until this very moment, investors who have been shorting the NASDAQ 100 with PSQ have been making more money compared to people holding RWM. You're fine to disagree with me and buy any other inverse ETF if you like. I'm merely informing you of the existence of some of the more interesting ETFs I've found. For me though, PSQ is just not within my risk tolerance, but it may be within your risk tolerance, so that's up to you to decide. The next part of this series of inverse ETFs I've been telling you about is just a series of ETFs to expand your knowledge. I personally don't know anybody investing or betting in these ETFs that I'm about to tell you, but I think it's important that you do know that these inverse ETFs exist. On the stock market, you may not know this, you can go short on precious metals like gold and silver. I was very surprised to learn this as well, and I found 2 ETFs you can buy to bet against gold and silver. The 2 of them are GLL, which is the ProShares Ultra Short Gold ETF. That's 2 times leverage, meaning that if gold went down $1 in price, you would make $2. And the second is ZSL, the ProShares Ultra Short Silver ETF, and this one is also 2 times leverage. We'll start with GLL, the Ultra Short Gold ETF, and this probably won't come as a surprise, but GLL, a bet against gold, has returned negative 6.5% since the beginning of the year, and this is because gold's price has held relatively stable and steady as inflation has risen, and the price of many stocks have been following. However, if there is someone out there who thinks and believes that investing and holding in physical silver and gold is a bad investment, this would be one way. If you were to buy an ETF like GLL, this would be one way you can profit from other investors being wrong buying and holding gold ETFs and physical gold. And if you think later that the economy will get better and stocks will go up, it's entirely possible that gold's price could suffer. Gold's price has fallen in the past on the ETFs, and so there is an opportunity here for you to make money. Now, I don't personally believe this, I'm just giving the counter argument, but you should be aware that this option does exist for you out there as an investor, and maybe there is a maverick genius investor who we don't know their names yet. Maybe they will bet against gold at some point and make a lot of money. So GLL is an inverse ETF for people who don't like gold. And the last inverse ETF I'm going to tell you about is ZSL, the ProShares Ultra Short Silver ETF. And if we look at this ETF's performance, unlike gold, silver's price has been ever so slightly falling and not keeping up with inflation, meaning that people who have been buying and holding silver have been steadily losing money since last year. So as a result, the ZSL Inverse ETF actually returned a very small profit of 1.01% or $101 on a $10,000 investment since the beginning of 2022. Again, I don't necessarily believe in betting against precious metals. Their prices do tend to be pretty stable, but I also understand that it is true that so far the price of gold and silver haven't been keeping up pace with inflation. In fact, to date, the only assets I've seen that have kept up with inflation are farmland, energy, and real estate. But just because gold and silver aren't growing fast or going up in price, it doesn't necessarily mean that it would make a good short. So there you have it. Those are the 5 most interesting inverse ETFs you can buy to make money from falling stocks and other commodities, as others are losing money on the stock market. It's really important that you're aware of alternative strategies other than just the orthodoxy, buy and hold, and you should be aware of things such as inverse ETFs. Be sure to follow my investing journal on Telegram for more detailed investing analysis that I can get to you instantly rather than you having to wait for me to finish a video. Become a channel member as well. I'll be posting detailed analysis in video form for channel members on individual stocks that might be good targets for a short in this market.